Good afternoon, everyone. I'm John Sciarretti from Novogradac and Company, and today I'm representing the Novogradac Opportunity Zone Working Group. On behalf of the working group, we are pleased and want to thank you for our opportunity to give our testimony today. Today I'm going to discuss three topics, none of which are original, going 13. But I think it's great that we're aligned in our interests today. So the three topics I will be discussing will be the special amount includable rule in the case of an inclusion event for investments in QOF partnerships and S corps. The second topic is the special 10-year exclusion election, which has been talked about a lot today. And then lastly, I'll talk about a grace period for QOFs and QOZBs to use property in the trader business. So with respect to the special amount includable rule, just a little overview, the regulations provide a special rule for an inclusion event, the inclusion amount with respect to pass-throughs. It's a little different than the statutory provision in that in the statutory provision, you take the lesser of fair market value or remaining deferred gain, less the basis in the investment. Where with pass-throughs, you take the lesser of the amount of deferred gain, less basis, or the gain that would be recognized on a fully taxable disposition of the investment. We understand why this rule was proposed, that it's intended to prevent taxpayers from avoiding recognizing deferred gain when the fair market value of their investment is diminished due to debt finance distributions. That's what we understand why the rule was presented. However, as Sarah indicated, it is adversely affecting investment in affordable housing and other high-impact community investments. Where the 10-year gain exclusion, as Mike's referred to, is generally less valuable to them, as they don't expect to have appreciation in their investment or much appreciation in their investment at the end of 10 years. However, they were pretty excited about the 2026 inclusion rule, the statutory rule, because it did provide value and that they could recognize this sort of typical loss in value over time at a certain date. So it gave them an accretion in basis. And in my experience of working with a lot of these local housing investors, they were excited. We were seeing non-traditional investors come to the table, and a lot of plans were being made for funds with syndicators and the like. And as soon as the proposed regs came out, it's been quiet. Folks have sort of walked away or stepped back from the opportunity zone. And so as a result, I think a lot of aspiring investors have actually turned away from the program. And so we're recommending, as I think Sarah referred to, we're aligned in this, that we make the inclusion rule in 2026 consistent with the mechanics of statutory rule, but that we add back, that we modify the definition of fair market value, and that we use the net value of investment, excluding debt, and then add to that distributions that were made. So these distributions that folks may have made to reduce the value of their investment, we propose that we add these distributions back, which we think prevents this artificial reduction in investment without adversely affecting affordable housing and other community impact type investments in these zones. So that's our first issue. The second issue is with respect to the 10-year exclusion election, which, as I said, many people presented this issue today, and that this proposed rule only applies to capital gains, and only applies to the sale of property by a QOF, not business. It excludes gains realized from the sale of property that's characterized as ordinary income, like 1245 depreciation we captured. And it also excludes any gains that are attributable to the sale of property at the business level. And so it's not on the same page. We think that the rules should be synthesized with with the rule for selling your QOF interest, where all gains attributable to the appreciation of property, all property, whether capital or ordinary, or whether the property is held by the QOF or the business, are eligible for exclusion. It's common, as has been said much today, it's common for, especially in multi-asset funds, to exit by selling assets. There's also likely to be a significant amount of operating businesses that will sell assets that produce ordinary gains. We see that in the market, especially in the renewable energy space. And then because most of the qualified opportunity zone property, in our experience, is going to be held by a business, not the QOF, simply because we have this flexibility of time to make our investment with the working capital rule. We think that it's important that we synthesize these two rules and expand the gain exclusion to apply to all gains attributable to the sale of any property used in a trade or business by a QOF or QOZB, with the exception of inventory or assets that are held for sale in the ordinary course of business, which is inventory. That was our recommendation. And then lastly, which was sort of hinted on today, with respect to a grace period for QOFs and QOZBs on the use of property in a trade or business. And generally, I think folks have talked about a grace period for a qualified opportunity zone business to become a business. And the statute does sort of allude to that, and that the statute says that new businesses must be organized for the purpose of being an opportunity zone business. So they're acknowledging that there is sort of this startup period at the business level. But we know that qualified opportunity zone business property must be used in a trade or business to be considered qualified. And we do have some sort of some safe harbor within the working capital safe harbor that allows you to sort of treat tangible property as existing even before you bought it. But there's really no discussion on use, and there's no discussion on how much time a business gets to use the property. So if a fund invests in equipment, let's say, and there's a period of time before they can actually put that in production, is that disqualified property at that point in time, or do they actually have to have it in production? Or even in the case of real estate, where if a business kind of satisfies the safe harbor, but in 31 months, it's not placed in service yet. And so, do they fail the qualified opportunity zone property at that stage because it's not placed in service yet? So we think that Treasury should consider a rule where a business is not treated as failing to satisfy the use requirements solely because the tangible property is not used in a trade or business before a reasonable startup period. That's sort of, all businesses are different. It's probably, 12 months might be good for some, but some may be different based on the nature of the business. And so before a reasonable startup period based on the facts and circumstances is sort of what we're recommended, that a business should have time before they have to use their property. Alternatively, if you do want to provide a safe harbor, provide that businesses have 12 months, but that 12 months doesn't start until after the 31 months. So that's our suggestion. And we're really suggesting it's both at the QOF and the QOZB level, because even at the QOF level, we have to use this property in a trade or business. So that's completes my testimony today on behalf of the working group.
I'm going to go first, actually, this time.
Okay.
Thank you, John, for your comments. There's one thing that keeps popping up for me. I was on a panel with Mr. Novogradac, and there seems to be a lot of push to have sort of special rules for affordable housing area, just to make them work. I know Jill talked about historic credits, and I've been asked about new markets. So I don't know if someone could provide me or provide all of us something with specific rules that you're looking for just for this industry, because it keeps coming up, and it's all over the place in different parts of the regs.
Yeah, I mean, in my experience, I think affordable housing works well with this program, at least certain types of affordable, bond probably work better than, 4% works probably better than 9%. But, I think that investors are sort of relying on the fact that they are losing value in their investment, and the benefit that they don't get at the end of 10 years, they can sort of accelerate this loss in value in 2026, and it provided enough incentive to encourage non-traditional investment in the space, because we saw it happen. I mean, people were pretty excited about it, and so it's not what you can do to help, it's what you did do to hurt, by giving us
Well, and
that rule, you know, and I think if you modify that rule, and I understand why you did that rule, because generally, folks could reduce the value of their investment by taking distributions before 2026, and so we suggested one way to modify that. There may be some other ways that don't hurt folks, you know, that are not trying to lose the value of the investment, but naturally the value may, you know, not be appreciating at least at 2026.
I mean, the reason why I asked is, Mike and I are very familiar with this space, but a lot of us, the rest of us on the panel and decision makers might not be so familiar with the space, and so I think it would be helpful to highlight those issues.
That's the one thing I can think about, but I think it's something that as a working group, we could convene and come up with some written response to answer that question.
Thanks, John. Two really quick hits. First, on the calculation of the gain, I just want to make sure I'm understanding where you're coming from. But suppose I invest 100 or roll over 100 or whatever term you want to use. So my outside basis is 100. I look at the statute, look at the deferred gain, $100 over the basis. Zero.
What
I have 100 of gain that I
outside zero.
Yeah.
Right.
So my outside basis is 0, but I put 100 in. So if I turn around and it was suddenly 12/31/26, putting aside the 10 and 5% bump ups, I'd have to pay tax on the 100 of gain. Okay. So I want to make sure I understand where you're coming from with the borrowing. If my gain is 100 and it's tied into that gain less the basis, and there's a borrowing without a debt finance distribution, I am now going to have a basis in my partnership interest of $100. Right?
There's a
There's a borrowing, 100 of which is allocated to me. 100 of borrowing is allocated to me.
Right, on the inside.
A borrow is $100 a borrow that's allocated to me.
Yeah.
100 that's
Yeah,
752.
yeah, that's correct.
So now I have deferred gain of 100.
Yeah.
I have a basis of 100 in my partnership interest, right? And I don't think you're suggesting it, but I just want clarification. One way to read the statute literally is to say the excess of the gain deferred 100 over the basis of 100 is the amount you pick up on 12/31/26.
No, I think you have to go net on that.
Okay, so you
Move it
back
back
out
to
the
basis.
basis. Okay, and so the question really is, when you walk through your calculation, adding back distributions and so on, is that written in your testimony?
It is.
Okay, good, we
It
can
is,
look at that.
yes.
Okay, and then back to the same old question on the -2C 10-year rule. It sounds like you're trying to get parity between a sale outside and a sale inside, right? Except that to the extent there's, any of the gain is attributable to property held primarily for sale. On a sale outside, that clearly would be excluded, it seems,
That's-
but inside it would not be.
That's right.
Right, so you're not looking for total parity.
Not total parity. I mean, you could always just make a big inventory sale after 10 years and
Right,
bring
right, right.
excluded, you know.
Right, and again, I've asked others, but would you be in favor of a rule that would require a distribution in order to avail yourself of the benefits of the 10-year rule for sales inside?
Yeah, the first I thought about that is when you asked others, and I'm trying to figure out, well, other than creating parity,
Yeah.
what else does that?
Yeah,
It
exactly.
doesn't solve anything, right?
Just one
Yeah,
secret.
right.
Okay, thank you.